Hi everyone, I am Dr. Jennifer Huang. I have been behind the scenes along all the weeks you guys are staying with Mark on the workshop. I've been designing the InvestUp program together with Mark, and hopefully so far you enjoyed what you are learning. If you ever listened to our podcast, you might recognize my voice. So now you can matching the voice with the face. Today, I'm very happy to take you guys through the Topic 7 PE's secret. And that is a very powerful tool that I developed the model, the calculator for you guys. So let's dive in. All right, before I start today's topic, I would like to go over the last week performance in stock track, looking at our performance ranking. Now, we have been into the program for 2 months. Overall performance ranking is return about 8 to 13%. Number one, Jago Martin has over 13% for 2 months. It's a really great performance. Think about the banking deposit rate. It's only 4 to 5% per year. If we have 13 divided by 2, it's around 6.5% for 1 month. That is beating definitely bank deposit rate. While for 1 week, our return look at top 1 to 10. It's from about 0.2 to 2.5%. However, our number one in this week is really high, 440%. So Jamie, if you are listening and watching this video, please do drop me an email. I checked your portfolio and I would really like to talk to you about how you achieve these results. Next, I normally every week will check our top traded securities to see how is our class doing. Now, the top traded securities in this week, the tech AI Magnificent 7 still dominates our trading list. However, with those familiar names, it's not surprising. But there are 2 new ads into the top traded list, which is ASML and SMCI. That are smart picks, and it's definitely somebody did their homework. Looking into AI ecosystem, especially ASML is a very unique company that producing equipment that required by the chip maker. So well done, guys, to spot out these 2 people in the AI theme. However, we also mentioned during previous workshops that AI is power limited, which means the energy stock now benefits because of the AI boom. The data factory needs power to run all those chips, and also they need the power to cooling down those CPU and GPUs. Last week, Microsoft CEO mentioned that they have lots of chips, NVIDIA GPUs, but they do not have enough power to cool down those chips. So guys, this week we put on a podcast with our energy analyst, Joseph, and talk to Mark about how to look into the AI energy boom, some ideas you can research. All right. The other one key things stood out during this week's trading is some leveraged ETFs used by our people. So my warning here is they are very risky products and only for short-term use. If you ever enter into those positions, please do a discipline check. Avoid overnight unless you are certain. Okay. Then we have our old friend, Mark Spencer, being traded on the list. That's a great start because we're going to follow up with Mark Spencer last week challenge. Did you run through the price growth driver before you buy? Did you figure out what is the driver of the price growth right now for Mark Spencer? Is that driven by EPS growth or P expansion? So having said that, we can do the exercise together to review last week. The data for Mark Spencer last week we asked you guys to collect is for financial year 2024 and 2025. The fiscal year of end for Mark Spencer is 31st March. And we find that 2024 ending EPS is 0.23 pounds. The stock price at the last trading day of 2024 fiscal year is 2.65. Well, for this year, 2025 financial year, the EPS just announced in March is 0.15 pounds. And the stock price on the March 31st, the last trading day, is 3.56. So the EPS dropped while the stock price increased. Now let's launch the tool to check what exactly the price being supported by which part. Let's input the data together. So Marks Spencer is in London Stock Exchange, ticker is MKS. We want to do 2024 fiscal year, 2025 fiscal year, and it's ending at 31st, 2024, and 31st, 2025. EPS chart is 0.23 and stock price starting is 2.65 and the stock price ending is 3.56. Let me use 15. Now let's calculate the results. The PE ratio expanded in 2025 from 11 times to 23 times, and the price goes up 34% by $0.91. Obviously, the EPS dropped. It doesn't support that price growth. 100% is supported by PE change expectation, and which means the market expects the Mark Spencer to do better for future earning growth. Okay, now you can see investment story about Mark Spencer is UK business turnaround. Will their sales and profit margin improving to justify the market expectation? We don't know. Therefore, before you buy Mark Spencer, you have to monitor whether earning growth for next several years can happen so that the market expectation is realized. Maybe now you will ask a second question. Market expected high growth because they gave 23 times PE. However, exactly how high and how much the growth can be translated from this PE 23 times, we don't know. And that is today's task. We actually can use the market price PE to figure out what are the implied growth rate for any company. That is coming to our learning objective is first, we need to introduce this very powerful tool. We call it InvestUp Calculator 2, Implied Growth Calculator. How it works, and we will use Mark Spencer to keep showing. Then we will interpret, once we calculate the implied growth rate of Mark Spencer, what does it mean, and how we can use it decision making to invest in Mark Spencer or not. Before I show you how to use this calculator tool, I want to briefly talk about the logics behind it. Previously, we already discussed that as an investor, your total return comes from dividend yield and price appreciation. And last week, we showed that use this basic relationship, price growth has to come from EPS growth and or PE expansion. As we discussed, keep PE stable, then your EPS growth are the fundamental driver for price growth. And we also provided calculator 1 for you to calculate that growth driver for price. Using an India case, we showed that the financial year 24 to financial year 25 price growth was purely driven by the EPS growth, while their PE stays stable at 50 times. However, life is not always the same. We just showed Mark Spencer's case. Its stock price growth in financial year 2025 was actually driven by pure PE expansion because we showed you their EPS is actually dropped. Here is the question. The PE expansion is market expecting the company will do better in the future. They will improve their profitability and provide you higher EPS earning. It is expectation, not confirmed by the company performance yet. If market expectation was not met by the company actual performance, obviously that PE expansion may be turned into PE compression. So we have to understand what exactly being priced in by that expectation of the market. That's our today's tool. We want current PE ratio to tell you what is exactly market expected for company to perform in the future. If the market expect them a turtle, while your estimation saying the company is a horse, can run faster, then you got a great case because you expect the EPS grow faster than market expected. It will drive your price growth and PE expansion as well. If market already priced in and expected the company to be a horse running pretty fast, then you got have confidence that company is going to run even faster, a flying horse. Then you can enjoy PE expansion to drive your price growth in the future. Well, if market already priced in the company as a flying horse, like NVIDIA 50 times PE, then if you want to enjoy price growth driven by PE expansion, you got to find a company that can beat this flying horse speed, going even faster like a rocket. That's the logic of our investment. If we want the price growth driven by PE expansion, we got to have full confidence that our estimated performance will be better than market expected. So today, the job is to find out exactly what market has priced in the company as a turtle or horse or flying horse by using current EPS level. Then we can compare with our own estimates to identify the best potential upside opportunities. When we introduce this second tool, it's very easy to use. It looks like that. Only one input point. You just input the PE ratio of any company you want to check. In our case, fiscal year 2025 ended March 31st. The PE ratio of Mark Spencer is 23.73. So now let's launch this calculator to say what the implied earning growth can we get from this market price. I said this is very easy to use. You just type in the PE ratio of Mark Spencer that we want to check. Right? It's 23.7. Let's calculate. All right. The result showing to justify a PE ratio of 23.7, the company needs to grow its earnings by about 20.0% annually for next 5 years, assuming a 10% discount rate and zero growth thereafter. So those are the key results we get. If you want to know the model, you can click on how it works. It will introduce you step by step. Basically, this tool is based on two-stage discounted earning model, which if you guys go into university, you will learn that. But I promised you guys there's no complicated maths. I want to highlight the assumptions we used behind this tool. We modeling the company's business development with 5 years of high growth, then absolutely zero growth. So we use very conservative assumptions because companies, just like when they are in young youth time, they can grow really fast if they have good opportunities. But when you enter into mature stage, it will be really hard to have fast growth. So 5 years high growth is relatively conservative because Microsoft, Apple, they deliver like 8 or 10 years high growth. But to make our model conservative for our decision making, we use this set of assumptions. We also use 10% discount rate, meaning 10% required rate by any investor in stock market bearing that stock volatility and risk. Continue our story. We just had the result running by our calculator, and you can see that 22% next 5 years high growth rate is expected by the market given the share price of 3.56 at the end of March 31st fiscal year 2025 for Mark Spencer. Now, with that result in mind, we can turn this implied earning growth rate into a powerful tool for stock selection. I want to introduce the decision framework. We need to use that market expected earning growth rate to compare with our own research. So if you are looking into Mark Spencer, you may have followed up their management decisions, strategies, how to improve the margins and profitability of the company. Then you can estimate company's growth based on all those foundational business drivers of the company to forecast your own EPS growth, earning growth. And if your estimated company growth rate is actually slower than market implied rate in Mark Spencer's case, which is 22% growth, market currently saying Mark Spencer is a horse, can run pretty fast, 22% per year growth for next 5 years. Well, if you work at the estimated earning growth is actually 5%, it's like a small turtle, then obviously the market expectation is too high. The price is too high. So we say it's overvalued. If you ever hold Mark Spencer, maybe you should sell. While if your own estimation for Mark Spencer is also around 20% growth for next 5 years, it's kind of reinforced, align with market expectation, then it's a fair value. The price just reflects what is expected to happen. However, the most desirable situation is if market saying the Mark Spencer is 22% growth rate in next 5 years, while your own estimation, you said, no, we checked all our research data, talked to the company management. We expect they can really execute their strategy very well to give us a 30 or 30 plus growth rate. Then it becomes a flying horse and they can run faster than the market expects them to run. In that way, market price is undervalued Mark Spencer stock. So you see, this is a little beautiful framework to guide you how to choose your stock.